If you still believe the Federal Reserve is running monetary policy for the long-term health of the country, I want to say something hard to you. That belief is getting expensive, not because the people at the Fed are stupid, not because every policymaker is corrupt, because the arithmetic has changed and the arithmetic does not care about prestige. That is the real story. The Fed did not just make a technical adjustment. It did not just send a dovish hint. It did not just tweak the tone of the next chapter. It revealed something much uglier, revealed that the system is now under enough pressure that monetary policy is starting to serve the debt before it serves the currency. That is a line no serious country wants to cross, and once you cross it, every asset in the system has to be read stocks, bonds, cash, gold, real estate, the dollar itself, everything. Because if the institution charged with defending the measuring stick starts bending under political and fiscal pressure, then the problem is no longer one sector or one quarter or one inflation print. The problem is the measuring stick. That is why I want you to stop thinking about this as another market update. This is not about whether the SP is a little rich or whether tech can squeeze higher or whether the next payroll number comes in light. This is about whether the most important institution in the financial system is still making policy from discipline or from necessity. That is a much bigger question. That is the mother line for everything I am about to tell you. When a central bank begins adjusting policy because the debt load and the political system cannot tolerate reality, the system has already moved from management to accommodation. And investors who keep using the old playbook are now carrying a risk they do not understand. That is the line. Read it again. Because once you understand it, you stop asking whether the Fed just helped the market. You start asking what it had to sacrifice in order to do it. That is where the truth is hiding. Most people still think of the Fed as a pilot, maybe imperfect, maybe too academic, maybe sometimes political, but fundamentally still flying the plane. I think that metaphor is getting stale. The Fed is starting to look less like a pilot and more like a mechanic, trying to keep an over-leveraged machine from throwing a rod at highway speed while the passengers argue about music. That is a different kind of institution, a more trapped one. And trapped institutions make different decisions than free ones. That is the point. I have watched this movie before. In other forms, I watched what Volcker did when the country still had the institutional backbone to accept severe pain for long-term credibility. He looked inflation in the face and broke it. He took rates high enough to make everyone miserable because he understood something modern policymakers hate admitting. Temporary pain is sometimes the price of long-term trust. He paid it. The country got 20 years of credibility and expansion out of that brutal honesty. Now compare that with the world we are in. A government running deficits so large they would have been politically unthinkable in peacetime for most of American history. Interest expense already above $1 trillion a year. A debt pile so large that even moderate rates now feel politically suffocating. An equity market still carrying pockets of valuation that only makes sense if the free money world quietly returns. And a central bank leaning in a direction that the fundamentals do not cleanly support because the debt machine and the political system need relief more than the monetary system needs integrity. That is the issue. Not one meeting, not one speech. The direction of surrender. Now let me show you how this actually works. I call the first mechanism the Volcker standard. The Volcker standard is not a number. It is not 20% rates. It is not some nostalgic longing for the 1980s. It is much simpler than that. It is the principle that the credibility of the currency is worth short-term economic pain. That was the standard. Volcker understood that if the public starts believing the Fed will always blink, then inflation becomes harder to defeat, debt becomes easier to abuse, and the institution becomes a servant of politics rather than a referee of money. That is the danger. You do not have to admire every historical decision to understand the principle. When the institution is feared enough, inflation expectations behave differently. When the institution is doubted, every promise costs more. That is what people are missing right now. The question is not whether today S-Fed should literally copy Volcker's exact dosage. The structure is different, the debt is bigger, the financial system is more leveraged, the economy is more financialized, The point is not imitation. The point is backbone. Does the institution still appear willing to choose credibility over comfort? That is the test. And the market is beginning to answer that question in a way I do not find comforting. Now let us move to the second mechanism. I call it the deferred bill. This one matters because people still talk about the post-2008 years as though they were a solution rather than a postponement. They were a postponement after the financial crisis. The country had a chance to clear more debt, accept more pain, and reset on a harder but cleaner base. Instead, policy chose cushion, zero rates, quantitative easing, extraordinary accommodation, more and more of it, that made asset prices go up. It made people feel richer. It made governments bolder. It made corporations more willing to borrow. It made investors reach further out on the risk curve because there was nothing else to do. And for a while, because the world was not yet demanding the bill, people called the architects geniuses. That is always the way with deferred bills. The person who postpones the pain gets praised first. The person who inherits the pain gets blamed later. That is where we are now. The bill for years of easy money was not canceled. It was delayed. Now inflation has arrived once, been partially beaten back, and is still close enough to the system that any move toward renewed accommodation carries a very different meaning than it did in the cleanly disinflationary world of the old cycle. That matters because people are still mentally living in the old cycle. They think the Fed can ease the way it used to ease. They think the market can absorb it the way it used to absorb it. They think the bond market will cooperate the way it used to cooperate, maybe for a while in spots, not with the same innocence. That innocence is gone, which means every accommodation move now has a larger shadow attached to it. The shadow says something like this: if the system already carries too much debt and too much dependence on lower rates, then every easing gesture is not just a support signal. It is also a confession that the structure cannot tolerate too much honesty. That is the deferred bill. The longer the real clearing was delayed. The more sensitive the system became to anything resembling normal rates and normal discipline. That is why what looks like good news on the screen is often bad news in the foundation. Now let us move to the third mechanism. I call it the debt spiral switch. This is where macro theory becomes ugly arithmetic. A lot of people hear $39 trillion in debt and their minds shut down because the number is too large to feel real. That is a mistake in markets. The numbers that feel too large to emotionally process are often the numbers that matter most. $39 trillion does not only mean the government owes a lot. It means the government's sensitivity to rates has changed completely. It means a rate level that once looked ordinary now starts behaving like a political toxin. It means the interest expense itself becomes one of the largest federal expenditures in the country. It means each new refinancing cycle has a bigger fiscal consequence than the last. That is the switch. At some point, debt stops being background. It becomes the lead actor. Once that happens, monetary policy is no longer just about inflation and employment. It is also about debt service, bond market absorption, treasury funding conditions, and the political survivability of the entire fiscal machine. This is the moment we are entering. A lot of investors still think the Fed is deciding between policy options. That is not quite right. The Fed is deciding within a box whose walls are built from debt. That is very different inside that box. Every decision is worse than it used to be. Raise rates too much, and the debt service burden worsens, growth slows harder, refinancing strains intensify, and political pressure rises. Cut too early and inflation expectations can reawaken. The long end of the bond market can rebel, and the institution's credibility can weaken further. That is the debt spiral switch. Once it flips, the central bank is no longer operating in a clean policy environment. It is negotiating with a compounding math problem. And compounding math problems do not respect press conferences. Now let us move to the fourth mechanism. I call it the bond market veto. This is, in my view, the most underappreciated fact in the entire story. Stocks get all the attention because people like speed. The bond market gets less attention because it is slower, larger, and more humiliating to the people who ignore it. If you understand the bond market, You understand who is actually convinced and who is just cheering. Right now, the long end of the Treasury market is not behaving like a market fully comforted by the idea of easier policy. That should stop you cold. Normally, if the central bank eases or signals accommodation in a way the market trusts long, duration bonds should feel better about the world, not worse. But if the long end stays stubbornly elevated or pushes higher, it is telling you something. It is telling you that the biggest holders of debt are not applauding the story. They are asking to be paid more for the risk. That is the veto. It is not dramatic. It is not loud. But it is far more important than the average investor realizes. A long bond refusing to celebrate easing is the market's way of saying, I see what you are trying to do, and I do not trust the implications. That is devastating, because once the bond market starts treating policy accommodation not as relief but as another sign of fiscal and monetary compromise, the entire meaning of easing changes. It becomes less like support and more like stress management. That is the bond market veto. And when it appears the old playbook breaks down, the old playbook said cuts are bullish. Lower rates support valuations, bonds rally, risk assets breathe, everybody carries on. But the new environment is not that clean. If long rates stay high because the bond market wants more compensation for fiscal disorder, inflation risk, or currency debasement, then the Fed can ease at the short end and still fail to restore the old world. That is what people are missing. The institution may control the front end of the curve more than the back end, but the back end decides whether the market believes the country still deserves the benefit of the doubt. That is where the judgment is. Now, not in speeches, in yields. Now let us move to the fifth mechanism. I call it the Tina funeral. For years, the market lived by a simple religion. There is no alternative. Rates were near zero. Cash paid nothing. Bonds paid almost nothing. So people piled into equities not purely because equities were cheap, but because they were the only game in town. That matters because it means part of the last cycle's valuation expansion had less to do with underlying business value and more to do with the absence of other options. That world is over. The funeral should have been attended by more people. But most investors still act as though it is a rumor. When you can get real return in short-term government paper, when cash-like instruments actually pay, when the risk-free rate exists again in a visible way, the justification for paying absurd multiples for growth assets gets much weaker. This is not complicated. It is one of the oldest equations in finance. If the alternative yields nothing, investors stretch. If the alternative yields something meaningful, investors stop pretending they are forced to own every expensive dream in the market. That is the Tina funeral. And yet much of the equity market, especially in the glamorous end of large cap growth, still carries valuation logic that was built for the old religion. That is a dangerous mismatch. A great business can still be a terrible investment if the entry price assumes a world that no longer exists. That is the problem. Not that these companies are bad, that the market is still pricing them like easy money is a birthright. It is not, which means the risk-reward equation in broad equities is much worse than the index buyer with his faith in passive religion wants to admit. That does not mean every stock crashes tomorrow. It means the air supporting a lot of them is thinner than the crowd thinks. Now let us move to the sixth mechanism. I call it the dollar privilege erosion. This one is slow, political, and absolutely critical. The dollar's role as the global reserve currency was never a magical law. It was a privilege supported by institutions, legal trust, fiscal seriousness relative to alternatives, deep capital markets, and the belief that the United States would maintain enough discipline to deserve the role. That privilege can erode without collapsing overnight. That is the mistake people make. They think reserve status is either fully intact or instantly dead. Number it can slowly decay, quietly, deliberately. One reserve manager at a time, one central bank at a time, one trade settlement agreement at a time, one sanctions lesson at a time. That is how erosion works. When Russian reserves were frozen, the message sent to the world was much larger than many Americans emotionally allowed themselves to believe. The message was not just about Russia. The message was that assets inside the Western financial system can become geopolitical tools quickly. Again, you can have whatever moral view you want about the specific case. I am talking about incentive response. Countries outside the core heard that message and adjusted their thinking. If reserves can be weaponized, then some portion of reserves must be moved toward assets and systems less exposed to political veto. That is why gold matters. That is why de-dollarization efforts, however partial, are real. That is why reserve diversification is not some fringe fantasy. It is risk management by sovereign actors. And every time the United States runs giant deficits, while its central bank looks more politically constrained and less institutionally independent, the incentive to reduce dependence on the dollar system grows. Not all at once, enough to matter. That is the dollar privilege erosion, and it is one reason I care so much about real assets and monetary hedges. Not because I think America collapses next Tuesday, because I think the privilege is being treated with a level of casual abuse that the world will not tolerate forever without adjustment. Now let us move to the seventh mechanism. I call it the correlation trap. This one matters enormously for ordinary investors because many of them still believe they are diversified when what they really own is a portfolio built for one regime. And when that regime breaks, the pieces they thought would protect them start moving together. That is the trap. A portfolio built during a world of falling rates, abundant liquidity, low inflation, and repeated central bank rescue can look wonderfully diversified on a pie chart. Then the regime changes. Suddenly the stock side is vulnerable because valuations were too rich and the macro assumptions too soft. The long bond side is vulnerable because duration risk is now real and yields are not collapsing the way the old model assumed. The cash side is vulnerable because inflation quietly erodes it if you hide there too long. Now, your diversification is not helping you the way you thought it would. That is the correlation trap. It is what happens when your portfolio is diversified by labels rather than by how assets behave under real stress. This is why I keep saying to stress, test the portfolio against the regime you are actually facing, not the regime you miss emotionally. If rates stay elevated, if the dollar weakens over time, if the bond market distrusts the long end, if equities re-rate, if inflation is not dead, if real assets matter more, run that scenario. Then ask yourself whether the portfolio is still diversified or whether it was merely diversified in a world that no longer exists. That is the honest test. Now let us move to the eighth mechanism. I call it the optionality reserve. This is where cash becomes interesting again, but not in the lazy way most people talk about it. Cash is not just dead money, not in a stressed regime. Cash is optionality. It is the right to act when others cannot. It is the right to buy when assets are being sold, not because they deserve it, but because their owners are trapped. The problem is that people misunderstand cash. They think the only job of cash is to earn a return or sit idle. Wrong. Cash is dry powder. Cash is emotional stability. Cash is strategic patience. Some of the best investments of a full cycle are made by the people who preserved optionality through the ugly phase and still had the ability to move when dislocation arrived. That is the reserve. I do not mean hide forever. I mean maintain enough flexibility that you are not a forced seller and are not fully committed to a set of assumptions that may be breaking. This matters because one of the most dangerous conditions in finance is being directionally right, but structurally trapped. You can understand the macro problem perfectly and still get hurt if you have no flexibility. Optionality protects you from that. It lets you wait. It lets you survive being early. It lets you respond instead of react. That is worth a great deal, especially now. Now let me make the identity flip explicit. Most investors think their job is to be bullish or bearish. That is childish. Your job is not to join a mood. Your job is to understand the regime and then own things that can survive it. That is the flip. Stop asking whether you are positive on stocks or negative on bonds or bullish on gold. Start asking whether your portfolio is positioned for a world where debt matters more, policy credibility matters more, the bond market is no longer cooperative, and the old Tina world is already dead. That is a much better question. A mood-based investor gets whipsawed. A regime-based investor becomes selective. That is where serious money lives, not in slogans, in structure. Which brings me to what I would actually do. First, I would stress test every equity holding against a world where easy money does not come back cleanly and valuations do not get the same indulgence they got in the last cycle. Second, I would be very careful with long-duration treasuries dressed up as safe assets if the bond market itself is telling me the long end wants more compensation. Third, I would hold meaningful optionality. Real liquidity, not because I love cash forever, but because I love being able to act later. Fourth, I would own real assets. Gold deserves a meaningful place in a serious portfolio precisely because it sits outside the promises of a system that is becoming more stressed and more tempted by debasement. Fifth, I would understand that diversification now means diversification across regime outcomes, not just across ticker categories. That is the operating system, not prediction, preparation, not panic, pressure mapping, not headline structure. Now let me say something that will irritate some people. A lot of investors do not really want serious analysis. They want reassurance. They want someone to tell them that the Fed has it, the market will do what it always does, the passive index will save them, and every problem will be solved by the same institutions that created half the conditions, now making the problem worse. That is not analysis. That is emotional outsourcing. I do not outsource my emotions to policymakers. Not when the debt arithmetic looks like this. Not when the bond market is sending signals like this. Not when the dollar privilege is being tested like this, and not when the valuations of the market's favorite assets still smell like the last cycle. This is why I am serious, not theatrical. Serious because the moment we are in is serious. Not because a crash tomorrow is guaranteed, because the probabilities have shifted enough that staying complacent now is a far bigger error than sounding early. That is the distinction. I would rather be early and structurally prepared than late and emotionally shattered. Now let me put the blade into this as cleanly as I can. The Fed did not just make a move. It showed you that the system is choosing short-term accommodation over long-term discipline because it no longer has the political and fiscal freedom to choose cleanly. That is the real signal. The bond market heard it. The dollar system is slowly absorbing it. Equity valuations are still not fully respecting it. Most retail portfolios are not positioned for it. And the people who still think this is just another buy, the dip episode, are carrying an assumption about the future that the arithmetic no longer supports. That is the danger. Not one meeting. A regime transition. That is what you are living through. You can ignore it if you want. The market will still price it. You can mock the concern if you want. The debt will still compound. You can trust old labels like safe, diversified, and Fed. Support it if you want. The bond market will still tell the truth when it is ready. I would rather listen now, protect capital, respect optionality, own real assets, question old assumptions. And above all, stop confusing the easiest short-term policy choice with long-term financial health. Those are not the same thing. In fact, in highly indebted systems, they are often opposites. That is what the Fed just showed you. The rest of the cycle is going to be about whether you are willing to believe what it revealed.